Last year, I was chatting with a trader I'll call David. David had doubled his account in 8 months. He was holding a stock that had just broken out to all-time highs. Everything on his chart was lined up like runway lights. Then, one morning, he called me. "I'm selling," he said. "I've got a 25% gain. That's a win." I asked him why. He paused and said the line, "I've heard 100 times from the average trader, it just feels too high." That day, he locked in his profit. 6 months later, the stock was up, another 400%. David didn't make money that day. He paid for an expensive lesson in loss aversion. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath and clear your mind. For the next few minutes, give your trading psychology your full attention. Because one insight today could change how you trade forever. A few years back, I read a book that changed how I think about holding winners. It's called 100 to 1 in the Stock Market by Thomas W. Phelps. Phelps studied stocks that multiplied 100 times in value and the patterns they shared. One of his warnings hit me hard because I'd seen it so many times in mentoring. In a bull market, he said, correcting mistakes often means taking profits too soon. We pat ourselves on the back for making money, but what we've really done is admit we missed far bigger opportunities. And here's the kicker. The stocks that tempt us to sell often look their best right before they go on to their biggest gains. That's when most traders take the bait. And it's when the patient, the disciplined, capture life-changing moves. Years ago, I made the same mistake David did. I was holding a stock in a young, fast-growing company. It had a unique product, sales were doubling. The chart looked like it had been drawn with a ruler pointed northeast. I bought in at what I thought was a great price. 6 months later, I was up 60%. I told myself I was smart to lock in the gain. The truth? I was scared to watch that green number turn red. I sold. Over the next 2 years, the stock went up over 900%. Every time I saw the ticker, I felt it. That little sting in the chest. Loss aversion doesn't just apply to losing trades, it applies to missed gains. It's the pain of what could have been. Phelps described this perfectly. He said the real danger in correcting mistakes is that we often do it when the stock looks its best. We're reacting to how good it feels now, instead of the possibility of what it could become. That's process versus outcome confusion. We think the outcome, a quick profit, means the process was correct. But if our process was about capturing long-term compounding, we just violated it. That trade taught me something I still teach every mentee. If your reason for selling is based purely on price action, you might be feeding fear, not following your system. And in the long game of the market, that's a recipe for mediocrity. So today, I want to talk about the psychology of holding big winners. Not the buy low, sell high cliché, but the actual mental discipline it takes to stay in when every instinct says, take the money. Because here's the truth. Finding a 100-bagger is rare, but holding one is even rarer. And the difference between selling early and holding on, it's not your chart setup, it's your mindset. This isn't financial advice. It's what I've learned through 15 years in the market and mentoring traders who've been exactly where you are. The market rewards patience, the way the ocean rewards surfers who wait for the perfect wave. Most people paddle for every ripple. They burn themselves out, chasing movement instead of momentum. But the ones who wait, who have the discipline to sit still, catch the wave that carries them all the way to shore. Phelps wrote that, in a bull market, correcting mistakes often means selling when a stock looks its best and missing far bigger opportunities. That insight sounds simple until you're the one watching a big green number in your account. In mentoring, I've seen this pattern dozens of times. One trader I worked with, Sarah, bought into a company with a breakthrough medical device. Early FDA approvals came through. Revenue doubled in 1 quarter. The stock jumped 30% in 2 weeks. She called me, nervous. "It's just too good to be true," she said. She sold. 18 months later, that stock was up over 300%. Why do we do this? Loss aversion. The pain of seeing gains vanish is psychologically twice as powerful as the pleasure of seeing them grow. Behavioral finance research backs this up. Daniel Kahneman and Amos Tversky found that losses are felt about 2.5 times more intensely than equivalent gains. When you understand that, you see why selling too soon feels safe, even when it's sabotage. Here's how I fight it in my own trading. Before I buy, I write down my sell criteria in plain language. Not just if it goes down 15%, but what fundamental change would make me want out. That way, when the chart is screaming sell, but the business is still delivering, I have a written reminder of my process. Phelps emphasized this, that time can be your ally if you own a company with no visible ceiling on growth. If the fundamentals are still intact, the best move may be no move at all. So here's your takeaway for this lesson. Don't let today's price action dictate tomorrow's potential. Have your exit plan before you enter, and make sure it's based on process, not fear. One of Phelps's biggest points was that good stocks are rarely without friends. If you wait for a moment when nobody likes them, you'll usually wait a long time, and you'll have to endure stretches where the stock seems to be doing nothing at all. A trader I knew, let's call him Mike, hated that feeling. He bought a small-cap tech stock with a genuinely unique product. The first 3 months, it moved sideways. Mike checked the price 10 times a day. Every time another stock in his watchlist spiked, he felt like he was missing out. After 90 days, he sold and rotated into the hot name of the week. That stock tanked. Meanwhile, his original pick tripled over the next 2 years. That's impatience and overtrading at work. When we confuse activity with progress, we start making trades just to feel in control. It's an emotional sugar rush, and like sugar, it leaves you with a crash. There's research on this too. A 2011 study from Barber and Odean found that the most active traders had the lowest net returns, often underperforming by 6 to 7% annually compared to more patient investors. Why? Because overtrading means higher costs, worse timing, and constant emotional whiplash. Phelps offered a better model. Focus on businesses where time compounds your advantage. Sideways periods aren't dead money, they're incubation periods. The fundamentals are working behind the scenes even if the ticker looks asleep. Here's how I coach traders to handle this. Instead of staring at price every day, track business milestones. Did the company land a new client? Increase margins? Expand distribution? Those are the green lights you can't see on a candlestick chart. The goal isn't to avoid action, it's to take the right action at the right time. Patience doesn't mean doing nothing, it means doing the right thing for as long as it takes. So remember, your job isn't to chase every ripple. It's to position yourself so that when the tide turns, you're already in the boat. One of the sneakiest traps in trading psychology is believing that if a trade made money, it must have been a good trade. That's process versus outcome confusion. It's dangerous because it rewards bad habits, and you don't notice the damage until it's too late. A trader I know, Jenna, had a knack for jumping into stocks that were already extended. One day, she bought into a retailer right after an earnings beat. It gapped up, ran another 10% intraday, and she sold for a quick win. She was thrilled. The problem? Her entry was pure FOMO. No plan, no defined risk, no understanding of the company's fundamentals. That same setup, repeated enough times, would eventually lead to disaster. Phelps warned about this in a different way. He reminded readers that to multiply your money massively, you need companies with no visible ceiling on growth, not just stocks that are running today. If your process is built on chasing yesterday's winners, you're aiming at the wrong target entirely. Here's why this matters. A winning trade based on bad process creates a false sense of skill. It's like winning at poker because you got lucky on the river. You think you're a great player, but the math says otherwise. In trading, luck can carry you for a while, but the market always comes for its money back. Behavioral finance research calls this resulting, the tendency to judge a decision based on the outcome rather than the quality of the decision itself. In poker, it's a career killer. In the markets, it's no different. So here's my challenge for you. After every trade, win or lose, write down why you took it. Be brutally honest about whether you followed your system. If you made money for the wrong reasons, don't celebrate. Fix the process before the market teaches you a more expensive lesson. Great outcomes can hide bad processes, but a great process, over time, makes great outcomes inevitable. Confirmation bias is one of the most comfortable and most costly traps in trading. It's the tendency to search for and favor information that supports what you already believe, while ignoring anything that challenges it. A trader in my Discord group, Mark, fell hard into this trap. He bought shares in a small energy company after reading a glowing write-up on a popular investing blog. From that moment on, every piece of news he consumed about the company was positive, because that's all he allowed himself to see. He followed bullish analysts, retweeted optimistic forecasts, and skipped over articles that raised concerns about debt and declining production. When the quarterly report revealed serious cash flow problems, Mark was blindsided. His position dropped 40% in a week. Phelps would have called this a failure to watch the right metrics. In 100 to 1 in the stock market, he emphasizes tracking hard data, sales growth, profit margins, returns on invested capital, the signals that tell you if the story is still intact. Ignoring those because they don't match your bias is like driving with your windshield painted over. Here's the psychology. Our brains love to protect our egos. If we've committed publicly, even if only to ourselves, we don't want to be wrong. So we gather proof that we're right and avoid proof that we're wrong. The problem? The market doesn't care how much evidence you've collected for your side. There's a study from Lord, Ross and Lepper in 1979 that illustrates this perfectly. Participants were shown mixed evidence on capital punishment. Proponents became more convinced it worked. Opponents became more convinced it didn't. Same evidence, opposite conclusions, because each side only saw what they wanted to see. Here's how I coach traders to fight it. For every position, actively seek out the best opposing argument. If you can't disprove your own thesis, you're not done with your homework. Confirmation bias feels safe. But in trading, safety built on selective evidence is just a trap with softer walls. Some traders lose money because they can't read the market. Others lose because they can't step out of their own shadow. The ego and identity trap is when your trades stop being just trades and start being a reflection of who you are. A trader I mentored, Alex, built his identity around being the guy who spots hidden gems. He was sharp. He found companies before Wall Street did. But when one of his big picks started missing earnings, he couldn't bring himself to sell. Selling would mean admitting he was wrong, and that clashed with the image he'd built for himself. So he held, and watched the stock lose 70% of its value. Phelps warned against this kind of attachment in a subtle way. He reminded readers that even the best companies face new competition, changing markets, and management shifts. His advice was clear. Ask how high and strong the company's gate against competition really is, and reassess regularly. Ego can make you skip that reassessment because you don't want the answer to change. Here's the psychological danger. When your identity is tied to a trade, you no longer see risk objectively. You defend it like you'd defend your own name. And that defense can cost you more than money. It can cost you adaptability. There's a concept in behavioral finance called the self-attribution bias. We credit ourselves for wins, I'm a genius, and blame losses on external forces, the market was irrational. Over time, that bias reinforces ego-driven decision-making, which kills flexibility. Here's how I coach traders to avoid it. Treat every position like a business contract with an expiration date. At set intervals, renegotiate with reality. If the terms no longer make sense, walk away, no matter how good the story once was. In the market, humility isn't weakness, it's a survival skill, because no matter how long you've been trading, the market will remind you that it's bigger, faster, and far less sentimental than you are. The patterns Phelps identified aren't just theory, they've played out in markets for decades. And behavioral finance research keeps confirming why most traders miss them. One study from Dalbar, tracking US equity fund investors over a 30-year period, found the average investor underperformed the S&P 500 by about 6% annually. Why? Because they chased performance, sold too soon, and let emotions drive exits. Take Amazon. In 1999, it traded under $100. By late 2001, it was under 10. Most traders bailed. But the ones who held and understood that the fundamentals of e-commerce growth were intact saw it climb to over 3,000 2 decades later. That's a real-world 100 bagger, or monster beverage. In 2003, You could have bought shares for under 10 cents, split adjusted. Over the next 15 years, it became one of the best performing stocks in history, returning over 70,000%. Most people sold on the first double or the first pullback. The few who held understood the moat, the gate against competition, that Phelps said was critical. Behavioral economics offers another clue. Terence O'Dean's research showed that traders are far more likely to sell winners than losers, a phenomenon called the disposition effect. It's loss aversion in action, and it's exactly what causes traders to cut potential 100 baggers down to 20% or 30% gains. Here's the connection. The companies that become 100 baggers usually spend years doing something new, better, faster, or cheaper, just like Phelps described. They hit stretches where the stock seems to do nothing. They survive corrections that scare out most investors. And they reward the ones who can separate short-term noise from long-term growth. The market will always give you a reason to sell. The skill is knowing when those reasons are valid and when they're just fear dressed up as logic. Before you enter any position, write down your specific sell criteria. Not when it feels high, but measurable conditions. For example, I will sell if revenue growth drops below 10% year over year for 2 consecutive quarters. This fights loss aversion by giving you a process anchor before emotion takes over. Once a month, pick your biggest position and build the strongest bear case you can. Use real data, margins, debt, competition, regulatory risk. If your thesis survives that stress test, hold with confidence. If not, reassess. This attacks confirmation bias head-on. Track business milestones instead of daily price. Log product launches, market expansions, earnings beats. Every milestone is proof your thesis is intact, even if the price hasn't moved. This keeps you from overtrading out of boredom or impatience. Every quarter, ask yourself, if I didn't own this stock today, would I still buy it? If the answer is no, your ego might be holding the position hostage. This keeps the ego and identity trap from quietly draining your account. When researching, ask Phelps's 2 key questions. How high and strong is the company's gate against competition? How good are the prospects for sales growth? If you can answer both with conviction, and the fundamentals keep proving you right, you have a candidate worth holding. So let me ask you, how many times have you sold just because a stock felt high, without checking if the fundamentals had changed? How often do you check the chart more than the business? Do you keep a journal of why you entered, and does that reason still hold true? When was the last time you actively tried to disprove your own thesis? Do you measure your trades by the quality of your process, or just the size of your gains? And the big one, if your favorite position started failing your original checklist, would you sell it, or would you defend it because it's yours? The way you answer those questions will tell you whether you're positioned for a 100-bagger or for another quick win you'll regret later. If there's one thing Phelps's work and years of mentoring have taught me, it's this. The biggest market gains go to those who can master themselves. Not just their charts, their mindset. Not just their strategy, their patience. So here's your challenge. Write in the comments the most valuable thing you've learned today. Share this video with a friend who's been selling too soon or overtrading. And if you haven't already, like, share and subscribe so you don't miss the next lesson. Master your mind. Master the market. Trade with confidence and live with calm.